Good afternoon, everybody. It's Thursday, July 14th, and it seems like every day we got more information, more news that we can share with you. And unfortunately, this year, not a lot of it has been good, but hopefully I'm going to give what I think are some glimmers of hope around what was a really terrible number yesterday. So the inflation number came out. Inflation was up 9.1% year over year. We learned that yesterday. We all feel it. We go to the grocery store, we go and fill our gas tanks. We know that prices are going up. The government has come back and said, well, the core energy, which is basically X food, X energy, has actually been going down since May. And that is true. It's below 6% right now, still historically very high, but not the 9.1% top line number we saw. And let's be honest, everybody's got to eat. We got to put gas in our cars. So looking at food and energy and pulling that out of the equation doesn't make sense for most of us. So inflation is high. The drivers, energy, and also housing. So I want to talk about both of those and what some of the Fed policy decisions in the future may mean. First of all, energy. Next month, we're going to see some numbers that reflect what has been occurring in the energy market. Oil has gone from about $130 a barrel down now well into the 90s. It's been selling off in the last 30 days pretty significantly. Unleaded gasoline over the last 30 days is down about 40 cents a gallon. Still at elevated numbers. Oil in the 90s is still expensive. Gasoline in the fours, mid fours, is still really expensive, but that at least is trending in the right direction. In terms of the housing market, we've obviously been in a really hot housing market for the last 2 years or so. That is showing some signs of cooling. I think a lot of that is primarily driven by the mortgage rates. Mortgage rates on average for a 30-year mortgage at the beginning of the year were about 3%. They bump up to almost 6%. Those rates are actually coming in a little bit right now, but they're still over 5%, which historically is actually pretty low. It's pretty cheap money if you're buying a house, but it does impact obviously people's ability to purchase homes based at least on payments. So I think you're going to see some cooling in the inflation numbers in terms of energy for sure next month, and also housing. And what you're also seeing too, just because buying a house has become more expensive, you're starting to see buyers walk away. Prior to the last couple months or so, only about 10% of homes that went under contract didn't close. Now nationwide, that's popped up pretty quickly to about 15%. A lot of that is just buyers saying, you know what, we're not going to pay it, we're walking away. And some of the hotter markets, that walk-away rate, if you will, or those contracts that failed to close, have been in excess of 25%. So you're seeing some real demand destruction that's happening with the increase in mortgage rates. Now, unfortunately, or fortunately, I guess, we need energy to run this economy. You really don't see the same demand destruction in terms of fuel prices unless the economy is in a recession. Now, I think we're in a recession. I said this a couple months ago. I also think that the Fed is going to have an easier job. I'm a little bit, I guess, contrary to the narrative that I'm reading. The narrative that I'm reading is that the Fed needs to do something crazy, like jack rates up to 7 or 10% to kill inflation in this economy. They've got to continue doing what they're doing. I'm actually in favor of what the Federal Reserve is doing in terms of raising interest rates. The short-term pain that all of us as investors are feeling because of that is going to, I believe, translate into long-term gains because, businesses, individuals, consumers, we need price stability. We need to have price stability to make purchasing decisions for the future. Businesses need price stability in order to make hiring decisions and build their business plans in the future as well. The Fed has to maintain price stability. I think they're taking steps to do that. So they're meeting the end of this month. They're going to meet July 26th. The meeting will last a couple days. They're expected now is about 100% probability they're going to raise their lending rate to 75 basis points. That would be the second such rate hike that they've done of 75 basis points 2 months in a row. There's now about a 50-50 chance that they might raise 1 point. If they raise 1 point, that's going to be a really historic move. The Fed began using overnight lending as a policy tool in the mid-1990s. A 1% move would be the biggest increase that they've done since then. I think that they are going a long way towards pulling some of this inflation out of the system. Remember, the Fed can't stimulate production, they can't stimulate supply, but what they can do is kill demand, and they're definitely killing demand. So what does that mean? I think that they are pushing us into a recession. The markets have indicated, based on how they behaved prior to knowing that we're in recessions in the past, usually what happens is when you're in a recession, you don't know it because the data's not out yet. And so I've said this in many of my other videos, usually the market starts going down about 6 months or so before it's announced we're in a recession. We're also going to find out the end of July when we get the GDP numbers if the economy is contracting or not. I said a few months ago, and I'm going to stick with that right now, I actually think we're in a recession. I think it's mild, I think it's relatively shallow, but I think that we are in a recession, and the price action in the markets has reflected that. And you're also now seeing, a couple months ago too, I did a video on the yield curve inversion. That basically means when short-term rates are higher than long-term rates, That's been a pretty good indicator in the past that we are in a recession, and the Fed is they're pushing that yield curve into inversion. We've got now short-term rates that are up, the 2-year Treasury rather is up above 3%. The 10 years now below 3%. So you're seeing long-term rates are falling while the Fed is pushing up short-term rates. They are inverting the curve. They are going to push us, I believe, into a recession. A lot of these things that I read saying that that we're going to be in a recession. No, it's going to be 2023. No, it's going to happen this year if we're not in it right now. At least that's my belief. And I also am going to be contrary in the sense that I don't think the Fed's got to go to 5 or 10% in terms of interest rates to kill the inflation in the system, because they're dealing with inflation that's been in our system now for about a year or so. When Volcker came in 1980, which is the parallel everyone else is making, where he really got aggressive, similar to what the Fed's doing now, but even more so, to get inflation out of the system, he was trying to kill inflation that had been in an economy for in excess of 10 years. The Fed doesn't have to do that. They've got to try to unwind some very inflationary monetary decisions and also fiscal decisions that have been made over the last 2 years. And I think that they are taking steps to do that. So my points of optimism are this. You're starting to see prices fall. What the Federal Reserve is doing is working in terms of killing some demand. We talked in the past about industrial commodities falling off a cliff really in the beginning of June. You're starting to now see energy, which really impacts us as consumers, starting to fall as well. You're seeing, the houses going under contract is starting to fall as well. They are effectively pulling some of that demand out of the system. So I'll keep you updated in terms of what I'm reading. There's a lot more I could say about this, but I'm already going 6.5 minutes, but I wanted to get some comments out. If this has generated any questions, please let me know or let a member of my team know. If you have specific questions about anything I discussed today, please let me know. If you disagree with everything I said today, also please let me know that. But if you stayed with me for 7 minutes now, I thank you very much. And until next time, have a great week, everybody. Take care.